Hello, and welcome back to the Encyclopedia of Commercial Real Estate Advice channel, where we give insider tips on over 500 real estate topics from the book, The Encyclopedia of Commercial Real Estate Advice by Terry Painter. Terry is a writer for Forbes.com. He's the president and founder of the Apartment Loan Store, where he has financed over $4.5 billion of commercial loans over the past 25 years. By matching each deal with over 40 of the top funding sources in America. So, Terry, before you go into these top multifamily loan programs, tell the viewers how you determine what are the best. And I assume you'll be going over each of the program's terms. And then, of course, what does it take to qualify?
Okay, I have ranked these based on number one, the ease of qualifying, number two, the lowest rates, number three, the lowest payments, number four, the best terms, and number five, the loan programs that have the best popularity with our borrowers. Okay, so I'm going to go over just the essential terms and qualifications now. You can go to the URL below on my website to find an extensive list of terms and qualifications for our most popular 17 multifamily loan programs. There it is. Okay, so let's start. Coming in at number one for the best multifamily loan in America is Freddie Mac Multifamily. Why? Because this non-recourse assumable loan has the lowest 10-year fixed rates, and best of all, from 2 to 10 years of interest-only payments, which means the lowest payments. Also, you do not need prior apartment building ownership experience. That means of owning 5 units or more if you live within 100 miles of the property. And you could get by with maybe as low as a 660 credit score, even though we usually like to see a 680 credit score, but we've gotten people approved with 660. And even better, there are no tax returns required. My clients that are refinancing love Freddie Mac because they can get up to 80% cash out, 80% LTV, I should say, cash out for any reason. Now, on the downside, these loans start at $1 million. So if your loan is $980,000, it's not going to pencil. You're going to need a net worth also equal to the size of the loan. You're going to need 12 months of post-closing cash in the bank. And without experience, you will need to hire professional management. Also, keep in mind that the rates on this program are a good deal higher in small markets. Okay, coming in at number two, might surprise you, it's community banks. Why? Because they happen to have really good rates right now, and their rates are competitive. They love to compete, especially because they don't want to lose deposit relationships. And if they could get your deposits, they're going to make you a much better deal. You could go to my book also to find out how to compete with all types of lenders. Okay, also, they have the lowest net worth and post-closing cash requirements. So a new investor can get their foot in the door, even if they don't have experience, and this makes it much easier. They also can lend smaller amounts under $500,000, and they can allow you to include the cost of major improvements or even rehab up to 75% LTV in the loan. So it's pretty good. On the downside, most community banks only lend in their own backyards. They hate interest-only payments, and they can only fix a rate for up to 5 years. Some maybe go to 7 years. They also require a 700 plus credit score. 2 sources of income is preferred, verified in the last 2 years of tax returns, and they hate cash out for any reason other than improving the property. Okay, let's go to number 3. This is one of my very favorites, HUD FHA multifamily. I've been doing these loans since 1999. This is my favorite for borrowers who want to keep the property forever, because we're looking at a non-recourse assumable loan that has a 35-year very low fixed rate with a 35-year amortization. LTVs go up to 85% and 80% for cash out, which if you're doing a refinance, and the program has no tax returns. There are very minimal requirements for net worth and liquidity as well. Now on the downside, the loan will take at least 8 months to close. So this doesn't work well for purchases, obviously. Sometimes we do a bridge loan if somebody wants a HUD loan to purchase a property to get them there. But that's more expensive because you got to take out 2 loans. Also, the program will require a multifamily ownership experience. much more expensive closing costs. There's a lot of red tape in this program, as you can imagine, because you're in bed with the government. But for those who want to hold it long-term and are looking for the long buck, you can't beat this program. It's about the best. Okay, coming in at number 4 is credit unions. What I love about credit unions is that they don't have prepayment penalties, which all other commercial loans seem to have. Just gives you a lot more flexibility. And also, if you want to fix and flip, they cannot be beat. Best of all, though, they have so much money to lend, so much more than they have customers who want to borrow money, that they can be very, very competitive. Also, they don't pay income taxes, which gives them a huge advantage over commercial banks, which do pay taxes, and that means they could offer lower rates. This also means they can dish out some better terms sometimes, and even fixed rates from 10 years or even longer. Another plus, you don't have to have experience, but these loans do require good earnings on tax returns and more financial strength that community banks want to see. And they also going to be looking for probably 10% of the loan size in cash in the bank, I should say, in their credit union at closing. Also, they're going to require you really to live pretty close to the property, or pretty close to their credit union as well, so that you could become a member. Okay, coming in at number 5 is regional banks. These banks differ from community banks in that they can lend larger amounts throughout the state, and also often in neighboring states. But best of all, they have the lowest 5, 7, and 10-year fixed rates. Only credit unions can beat them. And they can lock the rate at application, which is a plus. Most commercial lenders don't lock the rate until loan approval or prior to closing. Oh, and you can usually get cash out up to 75% LTV with these lenders. On the downside, you need multifamily ownership experience, a minimum loan amount of $1 million, a 700 credit score, a net worth equal to the size of the loan, and 12 months of post-closing cash. Coming in at number 6 is Fannie Mae Green or Affordable Rent Multifamily Program. This non-recourse assumable loan program can lend in very small markets with rates. I mean, we've made loans in markets of like 5,000 people, towns.
Wow.
They also have, their rates are about a third of a point lower than Freddie, and they can be fixed for up to 30 years, and Freddie can only fix their rates for up to 10 years.
Okay.
You could also get up to 10 years of interest-only payments based on leverage. The program is the same if you don't go green, but it's about 40 basis points or 0.40% higher in rate.
So Terry, I have an associate who just closed a loan on a multifamily complex, and he went very green on it. It was very energy efficient. Is this actually a financial strategy to do that because of the kind of loan you can apply for, and not just a strategy that aligns with his values?
Well, certainly. I mean, certainly you're going to lower the cost of operating the building, and you're going to, during times where, it's not such a landlord market, tenants are going to be attracted more to an energy efficient building. But also keep in mind that most agency loans, Fannie and Freddie, and also HUD, and also CMBS securitized loan programs can sometimes cut you a better deal if you go green. And rates are lower for sure for HUD loans when you go green. So it's definitely a plus.
Okay.
Okay, so let's go on to number 7. And this is also one of my favorites because we use bridge lending all the time just to come in with good financing when somebody wants to, improve a property, and it's going to take some time and they're going to have to empty some of the units to do it. So coming in at number 7 is our private debt fund bridge loan program. This is for borrowers who want to do major value adds or rehab, as I mentioned. And what I love about this program is that if the loan payments are not going to support the loan, you can often include the loan payments in the loan itself. Now, this is something that most lenders hate, certainly banks, because who wants to lend you the loan payments? That kind of like negates the purpose of the loan in the first place. Okay, so this is also a great loan for those who don't qualify at a bank because they have low credit, or maybe they don't have the two sources of income on tax returns that banks love. These loans also have lower rates than hard money loans. We're talking about rates in the 6.5% to 8% range versus for hard money, 9 to 12%. Loan amounts go up to 75% for the completed stabilized value and can often lend up to 80% of cost. Okay, so the main downside on these loans are the short term of 1 to 1.5 to 2 years, and they charge high fees if you want to extend.
Again, if you want to see terms and qualifications on our top 17 loan programs, go to the URL listed below. For current rates and terms on Terry's loan programs, you can find a link to that below as well. And lastly, if you just want to see more videos on everything commercial real estate, leave us a thumbs up, hit the subscribe button. We thank you for watching, and we look forward to seeing you on the next episode.